I want to welcome everybody to our halftime report presentation. We're very happy to have all of you here and look forward to sharing this important information with you. Just as a note, we will be recording this presentation and sending it out later. So if you want to listen to it again or want to review anything, it will be available. So if you have any questions during the presentation, please feel free to ask them. Chances are someone else is wondering the same thing. So what I'd ask you to do is put the question into the chat function so that we can see the question that you're asking. I'm getting a question right now, is if we can mute all participants, just to double check and mute yourselves, and you can post questions in the chat function. We're going to try to answer all the questions afterwards, so I can get through the material of the halftime report, because we have a lot of ground to cover, as you might expect, for this particular halftime report. So our firm, APS Advanced Portfolio Strategies, provides a range of services with the primary goal of helping our clients pursue their unique financial objectives. We want to help you develop a financial strategy tailored to your goals, time horizon, and risk tolerance. Before we get started, here are a few disclosures I'd like to bring to your attention. I'm not going to read them, but I'm going to leave them up here for a brief moment so you can read them. And it's important to understand that we're not providing advice in this. What we're trying to do is provide some color on the market, the economy, and give you a general idea of how things have evolved and potentially how things will look going forward. And so just bear that in mind as we move through this presentation. So one of our goals today is to discuss some factors that influenced market performance during the first half of 2020. Then review the underlying fundamentals. It would be impossible to cover everything that's happened so far, but we believe that focusing on some of the key developments may help give a clearer picture of the markets. Today, we will review where we've been, some key economic fundamentals, and what may lie ahead in the second half. This broad view is designed to help you stay informed and give you a better understanding of some of the perspectives guiding our investing process. Let's begin by reviewing how the stock market performed during the first half of 2020. Here's a snapshot of the S&P 500 index performance for the first 6 months of 2020. The S&P 500 index tracks the market capitalization of 500 large domestic stocks. The index is often viewed as a common benchmark for analyzing the performance of the U.S. economy. The S&P 500 ended 2019 at 3,231. At the end of June 2020, the S&P 500 closed near 3,075. Let's look at some of the key events that affected the stock performance in the first half. As we review these milestones, please keep in mind that it was an extremely volatile period, which reminded us all that the return and principal value of stock prices will fluctuate as market conditions change. As the new year began, stocks marched higher in January and February, lifted by the completion of a phase one trade deal between the U.S. and China, a monetary policy engineered to stimulate economic activity and growth. As we all know, the market narrative changed quickly as the COVID-19 outbreak spread throughout China. As it grew, the Chinese economy was devastated and other countries began to report cases of their own. U.S. markets remained unfazed until February, when health officials announced what was quickly becoming a pandemic would likely have a widespread impact domestically. In March, stocks swung wildly on news of economic contraction, the rise in domestic infections, general uncertainty regarding how far the economy might fall and how long the pandemic might last. The stock market moved higher in April as investors evaluated corporate earnings and some troubling economic data, and gains accelerated after April 21st on news of positive results from a clinical trial investigating a treatment for COVID-19. Stocks notched another solid gain on May 18th when the Federal Reserve restated its commitment to do whatever would be necessary to support an economic recovery. On May 26th, the following day, Memorial Day weekend, stocks surged due to rising optimism over economic reopening, reported declines in new COVID-19 cases, and further news surrounding the development of a potential vaccine. In early June, however, that optimism, which had driven stock prices higher those past several weeks, slipped away. On June 10th, the Dow dropped 1,800 points on reports of a jump in COVID-19 cases, which sparked worries of a second wave slowing the economic recovery. So we talked a bit about how the S&P 500 performed in the year's first half, but how does that performance compare to expectations? Let's explore. At the end of each year, various media outlets compile many Wall Street analysts' predictions for the year ahead. This slide shows the variety of projections shared at the end of 2019. How do those predictions compare to reality so far? As we mentioned on the previous slide, the S&P 500 finished the first half of the year at nearly 3,075. It may be unfair to compare actual mid-year results to a prediction made before COVID-19, but it is worth a moment to see where stocks are in relation to market expectations. And I might add that COVID-19 was actually news items in China prior to the end of the year. So there was some information that was coming through. Predicting where the S&P 500 will be by the end of the year has become even more difficult for obvious reasons, since it's challenging to estimate corporate earnings in this environment. And this is especially true today, since no one has a clear idea of when American spending and business investment may return to normal. Nevertheless, we'll discuss a little later in the presentation what Wall Street analysts may be looking for during the second half of 2020. Now, it's worth repeating at this point that the S&P 500 Composite Index is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of past performance of a particular investment or any particular investment in the S&P 500. Past performance does not guarantee future results, and the reality is you can't actually invest in the index. You have to buy some kind of instrument that mimics it. So the return and principal value of stock prices in the index will fluctuate as market conditions change. So shares, when sold, may be worth more or less their original cost. Important to understand that because we're going to talk about indexes throughout this presentation today. Now let's take a look at some economic and financial indicators to help understand how we got here. To put today's economy in perspective, let's look back at January 2010. We were emerging from an economic slowdown, the Great Recession. Here you see 20 speedometers representing 20 indicators. From corporate profits to energy costs, 17 of the 20 indicators were green, which suggested the economy had a solid foundation. None of the indicators were red. Let's fast forward to January 2020 of this year. 10 of the indicators reported positive or strengthening numbers, but you can see that an equal number of indicators had a neutral or negative rating. In particular, the political environment and geopolitical risk were in the red. In June, the speedometer suggested a more cautious outlook. 4 were green, 9 were yellow, and 7 were red. The widespread influence of COVID-19 is reflected in many of these indicators. We've seen some states open certain businesses, then adjust to the situation due to outbreaks. Some states may continue to give mixed signals until we move closer to a potential vaccine. By now, almost every American has been affected in some way by the turmoil brought on by COVID-19. It's fair to say that the pandemic produced unprecedented economic disruption and upended the capital markets in a way that we haven't seen since the credit troubles of 2008. In fact, I'll add a little note that I read the other day. The last time that the economy contracted this much in a single quarter was actually in another pandemic in 1958. with the Asian flu. In that year, it was a million people had died in 1958. I will note, though, however, that the population was less than half of what it is today. So by comparison, that also was a very powerful pandemic that hit the global economy. In the next several slides, we'll examine how the pandemic played out on the key drivers of stock market performance. Let's spend a few minutes on the Federal Reserve and how its monetary policy responded to combat the disruptions resulting from COVID-19 and the subsequent lockdown of the U.S. economy. Stemming from the lessons learned during the 2008 credit crisis, the Fed acted much more quickly and decisively to address the strains in the capital markets that were already beginning to emerge. Beginning with a surprise Sunday evening press conference on March 15th, Fed Chair Jerome Powell announced a drastic reduction of the federal funds rate to zero, as well as committing up to $700 billion in asset purchases to maintain liquidity in the credit market. Initially, the market greeted this move negatively, believing that the Fed saw more trouble than the market had feared. Stock prices. As the timeline illustrates, the Fed continued to implement new measures to steady financial markets. So I'm going to try and mute some people that are not muted here. Bear with me 1 second. Think I did it. Okay. Oops. Let's see. While the Fed implemented more programs than we have outlined, let's take a look at some of the key policy initiatives put in place during the worst of the market slide, including the following: the creation of commercial paper funding facility to buy short-term unsecured debt was crucial to ongoing business funding. The creation of a money market mutual fund liquidity facility to promote purchases of assets from money market funds, ensuring the value preservation of those money market funds. Established funding to support credit to large companies, including reviving the 2008 term asset-backed securities loan facility program to prop up corporate bonds. With the passage of the Paycheck Protection Program and the extensive distress in small businesses nationwide, the Fed introduced a lending facility to buy those PPP loans. This helped to facilitate bank participation by taking non-performing loans off the bank's balance sheets. Introduced sweeping changes to the Main Street lending program in order to make it possible for a wider range of small and medium-sized businesses to apply. What does it all mean? Remember back on the image that showed the stock market performance in the first half of the year? On May 18th, stocks notched another solid gain when the Federal Reserve restated its commitment to do whatever would be necessary to support an economic recovery. This chart shows the relationship between changes in S&P 500 performance and the 12-month forward earnings per share. As you can see, the two lines have generally moved in the same direction over the past decade. But what has happened in the last few months? The volatility in stock prices and earnings is the result of COVID-19. At the highest level, the Federal Reserve has three functions: to provide an effective payment system for the U.S., to regulate banking operations, and to conduct monetary policy. When conducting monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goals, one of the indicators the Fed monitors is the overall level of consumer prices, which helps to determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. This line graph shows the core consumer price index over the past 50 years. The core CPI tracks what urban consumers pay for a specific group of goods. This measurement doesn't include energy or food because those prices are often volatile. Some economists use this measure to track inflation. As you can see in this chart, the pandemic's influence on inflation trends has been dramatic in recent months. For example, when most states were urging residents to stay at home in May 2020, energy CPI dropped 18.9%. And as we'll discuss later, Inflation and expectations have a big impact on rates, at least how the Fed sets rates, and ultimately on the impact of rates generally throughout the economy. Let's take a moment to talk about wages and unemployment. This graph shows the unemployment rate and year-over-year wage growth for the past 50 years. Notice how these two lines relate to one another. Most of the time, wages and unemployment have an inverse relationship. When one goes up, the other goes down. But who could have ever expected to change in recent months due to COVID-19? As you can see in the chart, unemployment jumped to 14.7% in April 2020. In May, it fell to 13.3%, which surprised some Wall Street analysts. Where will it go in the rest of 2020? We don't really know. Many of the Wall Street's brightest minds are trying to figure that out right now. And as you can expect, the unemployment rate will be aligned with their outlook on COVID-19. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is extremely valuable as it surveys at least 500 households in the continental US each month by phone. The survey uncovers consumers' opinions regarding their finances as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of the gross domestic product. This chart shows a long-term uptrend in consumer sentiment, but like many other indicators we will see today, COVID-19 has changed that outlook. While most consumers believe that economic conditions could hardly worsen from the recent shutdown of the national economy, prospective growth in the economy is more closely tied to progress against the coronavirus, said the University of Michigan in its June 2020 report. The early reopening of the economy has undoubtedly restored jobs and income, but it has come at the probable cost of an uptick in the spread of the virus. This chart shows the long-term trend in existing home sales, but I wanted to draw your attention over to the far right side. You may have to squint a bit, but that last figure is 3.9 million, a dramatic drop from just a few months earlier. So are existing home sales a leading economic indicator or a lagging one? Leading economic indicators, I might remind you, are statistics that tend to precede overall economic trends. Building permits, for example, tend to be a leading indicator of new home construction. Lagging indicators are statistics that tend to follow a particular economic trend. So returning to our question, are existing home sales a lead or lag indicator? Well, existing home sales are a lagging indicator because they tend to be influenced by changes in mortgage rates. The household debt service ratio showed a critical trend as well. It gives us some perspective on how much revolving debt, such as credit cards, that households manage. As you can see, revolving debt hit a high in the fourth quarter of 2017 and has never approached that number again. Does it mean Americans are using debt more wisely? That's uncertain, but the overall downward trend means debt payments as a percentage of disposable income is remaining below 10%. And that generally is a good trend because it means households, we should say household finances in general, have becoming stronger. Before we move on to our outlook for the second half of 2020, let's take a moment to consider the variables that could upend such forecasts. The market's remarkable resilience in the first half of 2020 can be attributed to unprecedented monetary and fiscal support, as well as optimism regarding a potential COVID-19 vaccine. While the Fed has promised to continue supporting economic recovery efforts, it remains less certain that the federal government can maintain its pace of spending or that medical professionals will discover a vaccine in advance of the new flu season. In addition to the upcoming presidential election, other potential headwinds could cause stocks to retreat. The potential for a new wave of COVID-19 cases and a slower than expected economic rebound, as well as the potential for heightened geopolitical tensions, could all have an impact. We also can't discount the possibility that just like we saw with the emergence of COVID-19, that there is always the possibility that what trips the market up will be something no one could anticipate. Of course, no one can predict what will happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. So now let's dive into forecasts for the second half of the year. Some market strategists employ what's called a bottom-up target price to set their price target for the S&P 500. When setting a bottom-up target price, market strategists focus their attention on estimating earnings for all the S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. This chart shows the expected price target of the S&P 500 and compares it to the actual closing price of the index. But a word of caution in this type of analysis. Just because the closing price is below the bottom-up target price, it may not mean the market is undervalued. The bottom-up price target is a theoretical target. It may or may not be reached. And as you can see in the chart, the bottom-up price target has been above the closing price for some time now. Much like some of the previous charts, COVID-19 is having a rather dramatic effect. In this one, real gross domestic product is expected to drop anywhere between 4% and 10% this year. The Federal Reserve chart shows a dramatic rebound in 2021 and 2022. As you can see, longer term, the Federal Reserve sees the GDP settling in the 2% range. This is kind of an interesting chart in the sense that it gives you sort of a range with that T bar in the middle, and it gives you sort of the median of those projections. And of course, I guess we can surmise from this information that the median is really going to settle back down after we see the near-term impacts of GDP by COVID-19. As a wise market strategist once said, stock prices are based on earnings and what price people are willing to pay for those earnings. This chart shows the trend in corporate profits in the United States since July 2017. As you can see, profits dropped 12.4% to $1.67 billion in the first quarter of 2020. It was the sharpest decline in corporate profits since the last quarter of 2008. You may have also heard the expression that stock market operates as a discounting mechanism, quickly processing all available information and potentially future events. Clearly, the stock market isn't dwelling on the near-term drop in earnings. It appears to be focusing on the earnings potential 2021 and 2022 and beyond have. As we discussed earlier, the Fed is watching the economy as it assesses whether to further adjust monetary policy. Within the Fed funds rate at 0%, any reduction in rates may be unlikely, especially since Fed Chair Powell has previously said that he's not inclined to move into negative rates. So what could be ahead? Typically, if the Fed is going to make an adjustment to interest rates, they announce the change following their two-day meetings. Here's another relationship to understand. Bond prices and bond yields have an inverse relationship. In other words, when bond prices go up, bond yields go down. After experiencing years of low interest rates, many investors may be surprised to realize their bonds can lose money if sold before reaching maturity. Bond fund values may decline during periods of rising interest rates, but a changing tide in the economy doesn't mean you have to abandon fixed income. Often this movement is an important part of a well-balanced, diversified portfolio that can provide investors the income they need. Keep in mind, however, there is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification doesn't protect against market risks, but it can serve to reduce market volatility. And essentially, that's the function of bonds prices in a broad-based, diversified portfolio between stocks and bonds. They enable the portfolio to moderate that volatility. Tuning out the headline noise while managing your finances, of course, is not always easy. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on fundamentals like companies' earnings and economic data. We've gone over a lot today already, and if you remember just one detail from our presentation, we hope this is that Emotions have no place in investing. Market corrections are a normal part of market cycles. We saw a vivid and compressed illustration of this from March through May of this year. This chart shows the intra-year lows each year going back to 1980 in red, with annual returns in gray. In 2019, we experienced a 7% intra-year drop coupled with a 29% gain. So far this year, the markets are on a different trajectory, reaching historical highs in February, plummeting in March due to the COVID-19 fears and economic shutdowns, and demonstrating a strong rebound in April and May. Volatility can be uncomfortable, but it is normal. Managing your emotions during good times is just as important. Ultimately, taking a long-term view of the markets is essential when you're trying to persuade or to pursue your long-term goals. If you ever feel concerned or want to understand what's happening, feel free to lean on us for support. We're here for you. We can answer questions and try to help you make the most of your financial life. This slide shows why it's important to ignore headlines and focus on your time horizon, risk tolerance, and goals. If we look at the beginning of 2000 to the end of 2019, we could see the danger of missing some of those powerful daily jumps. As the chart illustrates, a 10,000 investment on January 3rd, 2000 would have more than tripled in value to over 32,000 by the end of 2019. Had an investor been out of the market and missed just 10 of the best days during this period, that investment would be worth only half as much, or 16,180. If an investor missed just 20 of the best days during the 20-year period, they would have essentially gained nothing. Missing 30 or more of the best days, an investor would have lost money. And take a moment to think about all the stuff that has happened since 2000, January 2000, all the different crises and the market fluctuations. Investors who sell stocks in response to difficult market conditions often miss those all-important best days because they often occur when everything seems so negative. I'm going to bring your attention to that black box up in the upper right, which is, I think, perhaps one of the most interesting. So 6 of the best 10 days occurred within 2 weeks of the worst 10 days. For example, the best day of 2015, August 26th, was only 2 days after the worst day, August 24th. And so you think, oh, those are easy to time. You can see them coming. They actually are very difficult. And when you're in an emotional state trying to trade the markets, it's probable that you're not going to be able to recover emotionally to sell before the 24th and then get back in before the 26th, essentially a day later. And that's proven time and again that even the best hedge fund managers fail consistently to do that. So we've talked a lot about today. I'm sure there's going to be a lot of questions, and I want to go now and address those questions if anybody has one. I don't see any yet, but please type in a question, and I'm happy to try to answer it. There's got to be some questions about the markets and about how the markets are and compared to the economy, et cetera. One thing I would like to point out while we're waiting for the questions, I read an article a couple of days back, and it was analyzing the returns of the market this year, which have been quite spectacular given the fact that the markets fell so dramatically and made such a dramatic comeback. One thing I will say is if you dissect that market and you look at the different sectors, the sector that is by far and large outperforming is information technology. It is the Googles, the FANGs of the world. And if you look at the top 10 performing sectors, you can see that the top 10 are primarily technology companies, And those top 10 in this year have earned a 37% return. If you look at the bottom 450, and I'm talking about the S&P 500, if you look at the bottom 450 stocks in the S&P 500, the return year to date is negative 7.7%. So what we're seeing in the marketplace is a severe amount of concentration in the return. And why is that important? It's because the FANG stocks and those technology stocks are on a market capitalization basis about 25% of the S&P's weightings. In other words, they're overly represented from a market capitalization weight. And when those stocks move, the whole market moves, but it doesn't mean in general that the companies are doing well. So that sort of explains the disconnect between the market and what's going on economically. If you look at market capitalization ratings, hospitality in the S&P 500 is about 0.1% of the market cap weighting in the S&P 500. So even though hospitality went down 67% this year, it had virtually no impact on the return of the market. So we have to be careful when we're looking at the S&P 500 when looking at the market and trying to see, how is this representative of what's happening? So I just wanted to point that out. We've got one question. How can alternative investments support your portfolio in the current financial climate? Alternative investments are essentially what we'd say are non-traded investments. Now you can get access to those through publicly traded vehicles or through private funds, but alternative investments are ones that invest, for instance, in private credit or private loans and things like that. The advantage of alternative investments is that they're not market correlated. So from a volatility point of view, they help reduce the volatility of the portfolio, and at the same time, because they tend to be in niche areas of the investment world, for instance, like I said, private credit or in private equity, for example, they tend to have outsized returns because it's not a readily accessible market. You need to have a specific expertise to enter those markets. You see a lot of pension funds and endowments investing in alternatives in order to offset market volatility and introduce a higher level of return for the portfolio. Hopefully that answers it. Do we have any other questions? I don't want to sign off without answering everybody's questions, but you can also feel free to contact me privately and ask me, what you think about the market and what are my opinions, etc. Are there any other questions? It's going to be sort of last call. Okay, here's a question. COVID has revealed and maybe further advanced reliance on the products of the IT market. Is that driving a growth in the IT market, and will there be a fall off after COVID? That is a very good question. The answer to the first part of it is yes. When I explained about the performance of information technology as a sector, say within the various indices, or you could look at the NASDAQ 100, which is the top 100 companies in the NASDAQ. Yes. So COVID has led to, and it's not just an investor perception where they're buying up these stocks. Amazon, for instance, had a huge record gains because people were forced to start buying things or wanted to buy things online as opposed to go to a store and purchase items. So, and Zoom also itself is a publicly traded, had just a tremendous earnings growth and also price growth, valuation growth. So that the answer to the first question is yes. Just it has had a tremendous impact, and that's really part of the market that's really been lifting up the overall performance of stock market around the world. The second question is, will there be a fall off? That's the $1 million question. I suspect there may be somewhat of a fall off, some sort of hangover of that kind of, party, because at the same time, people are human. And I think there's a desire to meet and convene. I don't think it's, digital virtual life is going to replace everything. So I think there will be a fall off. The question is, to what extent? So, and almost by any measure, you would, if earnings grow, the way the information technology sector is being priced, it's pricing dramatic earnings growth in the foreseen, forthcoming years. So it's going to have to sustain it. If it doesn't, then you will see a correction in those company stocks. We have another question. Are there predictions that construction will continue, especially government spending on construction, or has the market changed? That is another really good question, and I think it bears noting that the devil's in the details in construction. I think there is still a chronic deficit in housing, so any kind of government-sponsored housing or private construction in housing is still going to do pretty well, I believe. Now, the issue on, sort of private construction in, say, multifamily housing or mixed-use housing that you're seeing a lot in Los Angeles and other urban centers. The problem there is, I think the rent premiums behind those projects' forecasts and the profitability are fairly high. And the question is, are they going to have to start discounting rents in order to entice people in, especially when a good segment of the working population has seen some kind of impact from COVID-19? The negative predictions, and I think it's going to go hand in hand of how employment goes. So far, it's been somewhat resilient. A lot of the unemployment is related to lower level service economy sectors, not white collar professional jobs that stay at home, but they are predicting that there could be a potential wave of white collar layoffs, which would definitely have an impact on residential housing. Office housing, I think, again, if it's retail and office, I think there's going to be some big question marks on that. It's hard to say, and I don't know about predictions. It depends on who you ask. We work with some groups that do investments in real estate, and we place them for our clients who want to invest in real estate. If you talk with them, they're pretty. They often will tell you an upbeat story. It's hard to separate the wheat from the chaff, so to speak. I will say that government efforts to provide lower income housing, I think, will probably be a theme as we go forward. And I would think that as part of a stimulus package, especially if we see, sort of a Democratic sweep in the elections, which that's not a foregone conclusion, but if we do see it, we could see a major infrastructure bill. And even if we don't, even if we still have a Trump presidency, Trump has always been in favor of large scale infrastructure projects. So we could see something like that in terms of construction moving forward. So, and I will also note that during the pandemic, construction on existing projects was exempted. So a lot of these have continued to go forward during the pandemic, even though many other businesses were shut. So I think what the only part that has really changed is going to be use of office. So office space, it's going to be retail space / malls, and potential higher end mixed use multi-resident properties that are counting on high premium rents in urban areas. I think those you'll see definitely some impact and, near to midterm impact on those types of construction projects. That's from what I've been hearing and reading. It's not my prediction. I wouldn't claim to be an expert in construction, but that's what I've been hearing. That's a great question. Are there any other questions? Are there any other questions? I want to answer them all before we sign off. Any questions about the markets? Any questions about sectors? Any questions about bonds? One thing I will say, just in case, because we did cover bond prices and things like that, what we saw in the credit markets initially was a massive increase in the spreads of corporate bonds over treasuries. So there was a flight to quality, and a lot of investors, when they were selling off equities, were going to treasuries. They weren't necessarily going to corporate bonds or muni bonds. In fact, muni bonds, corporate bonds, and particularly what we'd call high yield bonds, so lower credit rated companies, saw a massive increase in the spread that those bonds were priced at over treasuries, which means prices were falling in order to, and yields were going up. Now that didn't last too long, and that's a good example of the Fed's intervention in the markets. Is the Fed came out with the $700 billion buying facilities, and they were buying not only corporate bonds like investment grade bonds, they were buying high yield bonds. They were also buying real estate investment trust, or REITs, to support those. So there was some widespread buying. So you saw a lot of these high yield opportunities evaporate pretty quickly. REITs fell off. Some REITs fell off as much as 70% and recovered. High yield muni bonds and high yield corporate bonds also tanked in the initial weeks of the pandemic, and then came back as the Fed stepped in because they created a backstop. And that's been a huge windfall for people who were buying munis instead of treasuries. So it's, there was a bit of rotation in the bond market too, where as people were buying long-term treasuries, smart money was selling long-term treasuries and buying short in order to take advantage of the capital gains they were getting on their long-term bonds. So you saw a lot of rotation around that during the initial phases of the sell-off. Are there any questions? I spoke a little bit just to give some people some time. Are there any questions about markets? Any questions about the economy? I'm loath to sort of step in about the COVID-19 itself. It's very hard to predict. The only thing I can say is as cases are spreading, we saw, sort of a summertime increase as the economies opened up. People were eager to get out, and people were eager to, especially young people, and we saw the spread of the virus. However, I will note, just to counterpoint that and make a positive note, the numbers of deaths overall have been falling, and that's been a good thing. Meaning more people were getting it, but fewer people were dying from it. That's been a good trend. Obviously, it's still not good that people are dying, but the fact that it's been declining is a good trend. And there's still a lot to be learned about this, but I get the sense that the worst of it is over. We still have to get through this. The worst of it is over, and now we're having 4 or 5 different vaccines come out at the same time. I suspect that within the next 3 months, these will get rolled out. I don't know how effective they'll be, but I think potentially this will pass by early next year. So that's sort of my personal point of view on that right now. It's not professional. I'm not an epidemiologist, but I think that that's where we are. So, and I think the markets have sensed that a little bit too, because you'll notice that even despite the headlines, and I would say like 90% of the time, the headlines are just terrible. And I would caution people against making investment decisions based upon those, because, you know, bad news sells, good news doesn't sell anything. So, and, you know, media outlets are about selling ads and et cetera. So a lot of it tends to focus on the negative, and the positive gets sort of tucked underneath. So you have to read between the lines, study carefully. And I think that's probably why you're seeing the support in the market as we go forward. It hasn't really resold off yet. Another question, two questions actually. Let me take them in order. Although we see empty freeways making our commutes nicer, I suspect commercial transportation may have improved with a boom in remote shopping. Is that true? Yes, I think that's true. I think there was an initial drop off in transports, and you know, we look at the Dow has a great transport sector that you look at. In fact, it was declining well in advance of our pandemic here. It was because it was started in China, and international shipping already saw a massive drop, and you're starting to see an increase. I happen to have a friend that works for a major shipping company that works on the China desk, and says, you know, business is booming. So I think that, yes, retail has increased that. I don't know about, you know, China direct to here, but the shipping volumes are increasing, and that's a good sign. So that's a positive note. Another question, a political one, which I'm loath again to dip my toe into. What will happen if Biden is elected? I'm assuming, well, he's the presumptive nominee for the Democratic Party. What if he's elected? That's a very good question, because, and we've talked about this in the past, there's not a heavy correlation between presidential parties, at least in the near term. If you look on a near-term basis or 1 or 2 year basis, there's not a big correlation between, say, economic and stock market performance and who's in the White House, believe it or not. Despite what newspapers want you to think and how all important and all encompassing it is, the data just doesn't reflect that. The data suggests that markets are driven by long-term economic trends. So policies are important, and what policies are being pushed by the administration and by Congress, that's important. That definitely has a long-term impact. But if not, it doesn't have a near-term impact. So I would say if Biden wins, I don't think it would have a there might be a short sell-off, because generally, you know, if you look at the financial world, investment world, you know, the first thing you're going to think is higher taxes, which is going to cause profits to decrease, which would mean a discount on stock prices. So potentially, if there's a remote hint that a Biden presidency would raise or be able to raise taxes on corporations, that would have a negative effect. But I suspect that would be short-term in nature. There's not even a big correlation between tax rates and stock market performance or economic performance. We've had great economies in high tax regimes, so it's not clear that even if there is a rise in taxes, that long-term that's going to have an impact. I think certainly the proper functioning of capital markets is probably an important thing. So to the extent that regulation could get in the way, that could be a negative, but that again would probably be a longer term trend. Any other questions? I do have a crystal ball here. I could peer into it and see, but it's been pretty cloudy lately. But any other questions for me? regarding investments or the economy? So if not, I would probably proceed to closing here on one note. If you have a question about your personal situation, about your personal finances and how you're invested, I just encourage you to reach out to us. Let's set up an appointment. Let's go over everything. Most of our clients are familiar with our risk analysis and how we align our portfolios with their risk profile. We use very sophisticated software to do that. And if you think that something has changed in your risk profile or your personal outlook, we need to update your profile. And that would entail us sitting down, talking, having a conversation, and trying to understand how we can adjust or make adjustments to your portfolio to meet those new guidelines on your goals and financial considerations. Capital gains, another question. Capital gains in a gains tax in a Biden presidency. This goes back to what I was talking about taxes. I think that's a very good question, by the way. So the policy that I think is being proposed on capital gains by the Biden campaign is that they want to abolish preference for long-term capital gains and dividends. So right now, dividends are taxed at 20%. Well, we're at the highest rate is 20%, whereas ordinary income that you might receive on your W-2, the highest rate is 39.5%. Likewise, for capital gains are taxed if it's held for more than 1 year. They're taxed at 20%. They're talking about just eliminating that and just taxing capital gains at ordinary income rates. So first of all, I will say California already does it, as well as the other states that have income tax. They don't give preferential treatment. So already in California, you don't have that in the California tax. I suspect that I think they're going to try and push this through. Obviously, there's going to be some resistance to it. But in the current political environment, I'm not sure there's enough support to resist a change like that, because people are, there's a growing consensus that it's just a preferential tax for the very wealthy. And when I say very wealthy, I mean, I'm talking about people who earn very little income from working and live off of investments. So that's a really elite class of people that actually do that. So I'm not sure the impact broadly on, certainly not the poorer classes, and I'm not even sure if it will really impact deeply the middle classes, because the differential between their effective tax rate and the current 20% on dividends there is not that much. So you might be a lot of people will be at, say, a 22, 23% effective tax rate at the federal level. So it's 3% more. It's more, but it's not earth-shattering more. Now, people who receive a lot of capital gains and dividends from their investments, and that they're going from a 20 to a 35, that could really have an impact, but that's going to be for the ultra wealthy. So not quite sure how it's going to impact most people, but obviously for those who are very wealthy, it's a serious consideration. And I suspect they will oppose any kind of measure like that. And by the way, just as it regards that, I think there will be like a net, if a Biden presidency, because of things like the capital gains tax, I think there potentially will be a sell-off, which I believe we saw when Obama won. There was a sell-off. There was like, oh, this is bad for the markets. But it was, over the long term, over the 8 years of his presidency, I would say the effect was fairly neutral. That sort of tax effect is fairly neutral. And again, if you look backwards in the data, I mean, there's companies like in Microsoft that started in the 80s in the 80s, we had very high tax rates. I think the top marginal rate was 70% in the Fed, which was subsequently cut over the years. But it didn't prevent companies like Microsoft and Apple from growing exponentially and becoming fabulously wealthy for the investors. So it's hard to say. In the end, it's really hard to say. So, but expect some near-term volatility around it. That's what I can say. Are there any other questions? Are there any other questions? So if there's not any other questions, again, I'm going to encourage you all to reach out to me if you want to speak with me personally or Glenn Michael. Please feel free to give us a call. And at that, I would like to say goodbye and thank you for being with us today.